One of the things that I'm excited to think about is you mentioned before off camera, you have at MacKenzie Investments a model in terms of the way to think about it, a framing of 4 different things that are relevant to thinking about this. Can you talk about that a little bit?
Sure. I mean, the whole pension crisis, what we're doing here is we're looking at the whole industry or the whole country. So it is a little bit unfair to overgeneralize a lot of those things. So there are phenomenal pension funds and countries which are extremely well prepared and individuals who are doing exactly the right thing. But what we do is we try to generalize in order to get a more broad view of what is actually going on. So the way that we look at it is that there are 4 design flaws within pension funds in general. So
Right.
And those 4 design flaws are demographics, then the underlying assumptions based on discount rate and return expectations is a big design flaw. Then what we have in addition to that is the vested interests, so who are the people who make the decisions? And fourthly, we have a conundrum where we have extremely high return expectations of those pension funds to hit their targets, and that is actually driving the asset allocation. Right. So it is not really possibly sometimes the best asset allocation that is possible in that moment. It is more that the return targets that a lot of pension funds have are driving the asset allocation.
So yeah, let's go into that one by one. Yeah.
So the first design flaw, I think it's pretty obvious. So pension funds were developed a long time ago and really got into prominence after World War II, and you saw a major pickup in corporations, but also local governments and federal governments. But during that time, we had vastly different demographics, right? At those times, we actually had a pyramid where we had lots of workers and very little retirees. And the models at that time to determine a sustainable framework for the welfare state were based on the data that they had available at that time. And they built those models and came up with different kinds of features. And back in the days, in the 60s, people only had to account for roughly 13, 14 years of retirement. So when people worked up until they were 60s, in their 60s, and then you only had to finance on average 13, 14 years in the developed world. If we fast forward to today, yes, the average age or average retirement age has inched up a little bit, but the years in retirement have exploded.
Let me guess, 20.
20, it's roughly 20. That's right.
That was pretty good.
Excellent, yeah. So it is, that's a 50% increase from 13 and a half roughly to 20. For any financial model, it is extremely hard to adjust for such a major change, because that means that at least they will need 50% more money based or relative to what their expectations were at the very beginning.
And how do they get that more money? I mean, some of that probably goes into the other design flaws, but in general, from a demographic perspective, how do you deal with that? Like, what are the facets that get you that more money?
I mean, that's the changes that pension funds need to do. That is definitely raise the retirement age. Then there needs to be some kind of increased contributions to adjust for the new reality.
Right.
And then there might also have to be a conversation on maybe the payouts, whether those assumptions or whether the plan that was originally come up with, if that's still relevant. Those are all not nice conversations to have. And that goes to the vested interests. That is another design flaw where we say, look, nobody's really interested in uncovering all the mess that has been created and has basically festered over those years, and only tiny little changes have happened.
Right.
The really big changes are still to be made.
And what about, I don't know if you go into this, but I would imagine, I mean, the first thing that came to mind when you talked about the demographics and you talked about savings to disinvesting, I thought immediately of spending and GDP changes. What sort of impact does that change in demographics have on the velocity of, the pace of GDP growth? Does it have any that you've seen?
I mean, I in general, the super big picture for me would be that we have overspent, because we had the security of the welfare state made people feel a lot more confident about the future and about their increasing living standards that people were more willing to spend money. And now the realization phase is kicking in where that security and safety that we obtained since the 60s and 70s is being questioned. And that would probably mean that there will be less spending going forward and slightly slower growth, because we also have a massive amount of unaccounted for debt. Debt levels are in general extremely high, but on top of that, we also have those unaccounted debt levels coming from the pension funds.
Right. So now what about the second part of the design flaw?
Yeah, that's my favorite. So the second part are the financial assumptions. So
right.
It is, for any model that you build, it is okay to put in assumptions for stuff that you don't know, or where you don't have a really good handle of what you put in, what your input factor is. But for a lot of those pension funds, and I would say the most prominent cases for that would be US states. So that would be public pension funds, let's say the teachers, firefighters, police officers, and so on. So those US state pension funds, they have still ridiculous assumptions embedded in their calculations. And what we've done is we reverse engineered that whole formula to see, look, what is your assumption? What would be a realistic assumption? And the assumption that is still embedded and prevalent in US states is that they think that they can discount future obligations at 7.1% and that their assets will grow every single year at 7.6%. And to put that into perspective, what does it mean to have a discount rate of 7.1%? That basically means if I had an obligation of $100, so I need to pay somebody $100 in 20 years' time, it is basically enough if I have $25 right now in my pocket that would be considered fully funded.
Right.
So I don't need to have $100 right now, I just need to have $25 and I would be fully funded.
Right.
And I don't think that's fair. I don't think that is a right calculation, that is not the right assumption, because let's say the time value of money should be significantly lower.
Well, given the fact that interest rates are so low right now, it would to the degree that that persists for a longer period of time, it would suggest that those discount rates are going to be lower, and they're not going to be able to discount at that level of in perpetuity. Let's say you have like a 6% discount rate.
Yeah.
What happens to that $25 to $100? How does that change?
Oh, it is dramatic. Yeah,
yeah.
It is. I mean, that discount factor has an oversized impact on the sustainability of a pension fund. So what we did in our models is we said, look, why don't we just use 4%?
Okay.
I would say 4 is not even really fair, because you want to give the impression that it is safe money. And because I want to give the impression that it's safe money, I think maybe a US government equivalent yield would be a fairly decent proxy. But let's just say we use 4%, which is significantly above what a US...
More than double.
Exactly, yeah. So if we go to 4%, all of a sudden, just for the US states alone, the deficit that the pension funds have would go from $1.3 trillion to $4.3 trillion. And that is a big difference. So that also means that the funding status, so right now pension funds are saying we have a funded status of, let's say, 74% or so. And if we use a discount rate of 4%, all of a sudden that switches to 47%.
Right.
So that is a dramatic difference in terms of how funded, how well able those pension funds are actually to meet their future obligations.
And the other side of that, you said, was the 7.6% asset increase assumption. We've already just said, I looked at treasuries today, the 10-year was yielding 1.84 or thereabouts. How do you get to 7.6% in that environment?
Yeah, it's difficult. I mean, I'm a fixed income manager, so for me those numbers are completely out of reach. I mean, just to give you an idea what 7.6% would mean maybe in the sovereign bond space. So if you buy a Ukrainian bond, a 20-year Ukrainian bond, you're not even getting to 7.6% yield. It is pretty aggressive. And of course, they have a very diversified portfolio, and there are higher returning assets, let's say probably in the private equity space and infrastructure, equities, of course, and other assets. But still, achieving or trying to achieve and trying to hit 7.6% every single year is extremely ambitious because it doesn't account for market variability.
Right.
It doesn't account for that we're at record highs in almost any asset class, right? We're at record highs in equities, in fixed income, in real assets. At some point, we'll have a few years where we don't hit those 7.6%.
Right. And you know, that gets back to the risk, and that's part 4 that you're going to talk about in a second. But what's the third flaw that you've talk to me a little bit about that?
Yeah, so the third one would be, let's say, vested interests.
Right.
Here,
I think of it as an agency problem.
Exactly, yeah. So here it is just nobody wants to uncover what's really going on. Mm-hmm. It hits the pensioners themselves. It's tricky to ask the difficult questions and to demand answers on, is my pension sustainable? Because in a way, one sleeps better believing that one is safe than to ask and put all that effort into those probing questions and making sure that you get those right answers.
But you know, let me just say that, let's say you're a U.S. state and you're underfunded by 53%, that's
Yep.
the 47% that you said, versus 26%, then suddenly you're going to have to cough up a lot of money. And from a budgetary perspective, that doesn't look good for you as someone who needs to be elected in, you know, a year or 2 years. It's a lot easier not to make that decision.
Oh, absolutely.
And let someone else make the decision, you know, like 5-10 years later.
Yeah, it's better to pretend, because the real consequences of this would be for states to pony up a lot more money. Right? And who wants to do that? Everyone wants to get reelected. Do you really want to? And you have two choices, right? You can either reduce expenditure or you can increase revenues. Taxes, right. And both of them are not really vote winners.
No.
So it is difficult to make that decision now. It's better to just say, let's let somebody else deal with it, or let's just put some lipstick on it and hope nobody will take another critical look at it.
Well, you know, the other option is to roll the dice. I mean, this goes to the fourth structural flaw.
Perfect, yeah.
You could move out the risk curve. You could move out the duration curve, which you could, tilt your asset allocation. Tell me about that.
Yeah, I think that is what's going on. Pension funds have that sticker target of we need to achieve a significant return on our assets, which is good. Yes, it is good to be ambitious. It is good to have certain goals that you want to hit. But if that is going to the extreme that it actually influences how you make your asset allocation decision, it might tilt you away from what is actually a sensible asset allocation to something that is overly aggressive. And I would put it into the context of all those pension funds are maturing. Right? It is just like us. When we're young, we should have a high tilt towards risky assets, towards also illiquid assets, in order to gain that extra return, that extra liquidity premium, for example. So it makes sense in our early days of our personal career or personal lives to have a very high exposure to those higher potential assets. But as we progress, as we get older, of course, we need to adjust also how we're positioned, because the sequencing of returns will become much more important, right? It is, if you are in the payout phase for a pension fund, then you cannot really have drawdowns which are significant, because that will really compromise your ability to pay back. If you have that drawdown early on in your career, there's a high chance that you will recover from that. Later on, it will be difficult, which is why a lot of pensioners will get the advice from financial advisors to reduce their risk and put more money in fixed income and cash and so on.